Everyone talks about complex strategies and picking winning stocks. But what if I told you that the best path to a $3 million retirement is to keep it simple and to stop doing so much? Today, we're going to be taking a look at Kevin's portfolio. Kevin is 36 years old, and he's an NCAA soccer referee. He officiates the D3 games and even some D1 games, and it's something that he's been doing for over 20 years. It takes pretty thick skin to take a lot of yelling and complaining from a Karen on the sideline because you just gave her daughter a yellow card. To do that every single weekend and to wonder whether or not the torta mom is going to be in the parking lot waiting for you because she has an earful for you and she might even hit you. It takes a special kind of guy. And unless you're doing it at the highest level, you're going to make starvation wages like I do on YouTube. So Kevin keeps a roof over his head as a Social Security worker. So if you're not from the US, that means he's a government employee. He's single and he does not have kids, so his overhead costs are really low. So with that out of the way, just keep in mind, please, that none of this is financial or personal advice. All of this is just for fun coming from an idiot, me, that has an MBA. So if that sounds good with you, let's go ahead and get into it. So what you see on your screen right now is Kevin's holdings across his TSP, his Roth IRA, and his HSA. In other words, taxes do not matter here. They're all in tax-free or tax-deferred accounts. The total valuation at the time of filming this video is $169,000. Dude, I love that 69 number. Maybe I'm immature. It is what it is. And he doesn't have that many positions. As you can see, he has 4 funds that represent the US, and he has 4 funds that represent international markets. He's not doing a whole lot here, but it is kind of interesting to see an American have 76% of his money tied up into US equities and the other 23.4% into international stocks. But he did disclose to me that he's trying to get it to a number closer to 50-50. That's pretty wild. All right, so what's the goal of his portfolio? So because he's a government employee, he has a pension. And he firmly believes that Social Security, the agency that he works for, it's still going to be around when he's old enough. So he just wants enough money in his brokerage accounts to make work optional by the time that he's 57 or 58 years old. So a little over 20-ish years down the road because he's 36 right now. And it's not a hard role, but he would like to attain at least $3 million and financial independence. Which I'm telling you right now, in 2026, pensions are a dying breed, but it's an amazing safety cushion to fall back on. So when you think about the industries that still give you a pension, I think UPS might be in that conversation, but I think they're trying to get rid of it or buy people out that are already in the pension plan. So in the civilian sector, it's really hard to find one, but the US military, law enforcement, the public sector, teachers, and even some union trades, they still give a pension. Now, granted, even though pensions are disappearing, 401k accounts are all the rage right now. So if you put in like 3, 4, 5%, your employer is going to match it. So that's basically your version of the pension these days. And what's the strategy of Kevin's portfolio? How does he plan on reaching $3 million? Well, he's prioritizing small caps, as you can see by his ETF holdings. He's also emphasizing value stocks and the international markets. Now on this channel, we might see like 5% of a portfolio allocated to something overseas, but to see 23.4% and that number going to turn into 50% in the future, that's the first time on this channel. And his second strategy is to allow actively managed funds to do the buying and the selling on a timely basis. Every single one of these funds, except the S-Fund and the C-Fund that's associated with the TSP, they're actively managed. So it's not a passively managed investment vehicle. And then number 3, Kevin's dollar cost averaging without emotion. Every 2 weeks when his paycheck comes in, he just pumps it straight into his various brokerage accounts. So I have to applaud him on that kind of discipline because I know some people, they like to time the market. Some people, they only invest when they feel like it. And when you get emotions and feelings involved when it comes to the stock market, sometimes you can make really bad decisions. Like having one too many drinks on a Saturday evening because you were feeling yourself, maybe it was the college football championships, and you started drunk texting your coworker, and the next thing you know on Monday morning, HR wants to see you. I think the saying goes, don't drink and drive, but we should also never ever drink and make investment decisions. That's a piss poor kind of a decision-making process, I promise you. So on a high level, what are my thoughts and opinions on Kevin's portfolio? I spent a lot of time with this one because it's really against my value system of what I am bullish about. Because as you know, I'm super bullish about the American economy and the stock markets. However, with Kevin's portfolio and his vision, it's hard to argue with this one. I think it's simple, but I think it works. And my left nipple promises that I'll circle back on the whole American versus international markets argument. So when I say that 99% of the people watching this video, walking out here with a crusty butthole because you didn't wipe enough times, 99% of you have no business picking and investing into individual stocks. So when I see Kevin's brokerage accounts like that, dude, it makes me really happy. It's exactly what I'm talking about. A perfect example of defaulting to market-wide index funds rather than gambling. Rather than trying to be all cute and putting $100,000 into an individual stock and praying that it goes up. Other than that, I love the fact that he's maxing out his tax-friendly accounts instead of putting money into an individual taxable account because, believe it or not, that's the proper order to do it. That's not financial advice, but it makes all the sense in the world to max out your Roth IRA, your 401k, your TSP, whatever accounts first, because you get matching contributions from your employer or tax benefits, and then you invest into the individual taxable account. I'm not trying to say that's biblical truth, but on paper, that's what makes sense. And I hate that as a guy that gets it. Why is there no SCHD? I'm not trying to be that guy, but a quick shout out to SCHD. Why is it not here? By the way, I'm just joking. I think Kevin, from my understanding, he's prioritizing and he's focusing on total return, the performance, growing the portfolio's valuation as much as possible, as fast as possible, rather than, dividend yield and getting paid now, that passive income. So I think his priorities are fundamentally sound and it's coherent, but low key, SCHD's CAGR is pretty good in his own right. I mean, if we just zoom back 6 months ago, yeah, they were pretty horrific and ugly. But in 2026, the rotation into value has happened, and now SCHD is probably one of the best performing ETFs out there year to date. It just goes to show rotations happen all the time. What's ugly today might be beautiful tomorrow. What's beautiful today might have armpit hair tomorrow. You don't know. And that's why people advocate for staying diversified. And before we go anywhere else, I'm going to stop this car because according to the community poll that I just asked y'all, 6 days ago? I was like, hey, here are the facts with what's happening in America. Number one, the comeback of the Monroe Doctrine, high Venezuela. Number two, the transatlantic fracture between NATO, Greenland, and the US. Number three, escalation in the Middle East. Number four, the never-ending tariff debacle. Like the other day, the Supreme Court ruled that it was illegal and we shouldn't be able to do it. And then the party in power administered an emergency 15% tariffs across the board. So it's like never ending. Even though it's supposed to go away, they make a comeback out of the blue. And then number five, inflation and questionable GDP growth. So 355 of you guys participated. 30% of you said this is the time to buy into America because the stocks and equities are selling off, so you buy into it while they're at a discount. Whereas 13% of you said, dude, right now, if you invest into the US, you might see a flat CAGR for 2026, 2027. It's probably better to invest into the best in class in Europe, Asia, South America. And then 50% of you, I think this is probably where I fall into the camp of, is I buy stocks regardless of who's in office. Because presidents and administrations and ruling parties, they come and go. But the stock markets, the compounding effects, it takes time to occur. So I'm going to be investing regardless of what's happening. So I'm really happy to see that 50% of you guys see eye to eye with me. And it's not because it's an echo chamber and we're high-fiving butt naked while taking a shower together at the public gym. No, it's because 13% of you will see Kevin's portfolio and you're probably salivating right now. You're in the corner jerking off like this is an amazing portfolio. And I just want to stop you right there. Shine the flashlight into your car. What are you doing, you disgusting pig? Because in the second half of the video, I'll be showing you some data as to why I remain an American bull and why I'm not following the trends of jumping into the international stocks. So let's quickly go over the portfolio scorecard. The first metric and criteria is going to be asset and strategy fit. Do the positions and holdings make sense for their goal? Now, this might be an unpopular opinion, but you got to keep in mind that we're going to be evaluating this portfolio as is in the context of the stated strategy and what Kevin wants. I might not see eye to eye with him, but does it make sense? Overall, I would give it a grade letter of an A. Absolutely makes sense for what he's trying to do and achieve. To elaborate on what I was just saying, you only really need SCHD and VU. Call it a day. You'll be a happy camper in 10 to 20 years. Or in Kevin's case, a few market-wide index funds, different flavors, but it's still ice cream. And ice cream is good regardless of what you're eating. Unless it's pistachio, you're disgusting. If you eat pistachio-flavored gelato or ice cream, dude, I don't even know what kind of freak you are, but like, stop. But jokes aside, depending on your priorities and your agenda, like if you favor passive income or international exposure, just going with a few index funds to do the work for you is probably the best option. I know, it's crazy, and you're absolutely right to call me a hypocrite, because across this channel, I talk all the time about individual stocks and how I invest into said individual stocks. But that's because I have the time to research, analyze, and most importantly, beat the market consistently. Dude, I love to do what I do. However, it's a lot more stressful than dollar cost averaging and just passive investing into SCHD and VU, or in this case, a few handful of funds that can get the job done and then some. So it's really up to you whether it's worth it or not. Do keep in mind, I don't have a crystal ball. I don't always have a 100% accuracy rate, because if you go the individual stocks route, you might be watching your trade desk position go 50% in the red like I am. And it's variables like that that you are subjected to if you do individual stocks. You don't know if it's going to be a 2, 3, 4x, or if you're going to lose 50% of your money. Whereas with index funds, even if there's like big violent swings, for the most part, this is not 100% truthful, but usually like 95% of the time, the good tends to outweigh the bad in an index. And so instead of having like a violent swing to the red, you might see like -2, -3%. But it goes both ways, because you might also experience a few of the stocks explode in valuation, but because of the losers weighing down the index, instead of seeing 150% like you would with an individual stock, you might only see plus 7% for the day. So whatever. And when we talk about the level of risk, 1 out of 10, 10 being YOLO sports gambling on the Tottenham Hotspurs to survive another relegation battle, 1 being a high yield savings account. I know what I'm about to say will get me canceled, but I don't care. I think it's a 2 out of 10. Yes, I understand that he's 100% invested into equities, but he's diversified across the board. And I think as a result, when you think about investing into equities, doing it Kevin's way, I think it diversifies away the risk, because alternatively, he could YOLO into just one speculative stock. But that's just not the case, right? He's globally diversified. He has large caps, small caps, and international markets. So if we do see a market-wide, without discrimination, everyone gets hit hard, a 20% correction like in April 2025, it's just going to be a speed bump for Kevin's portfolio. It's not going to be a death sentence. Given time, he's going to be just fine. If you look up the S&P 500, if you look up the NASDAQ 100, the Dow Jones Index, international markets, everybody tends to do okay in the grand scheme of things, unless we're talking about a very niche market or a very niche index, which is not what Kevin's invested into. So please don't be that wise guy with a 1-inch dong typing that up like, oh, I can't wait to unnecessarily correct this bozo. This is how I know you have small feet and you don't know what the heck you're talking about. The fact that Kevin doesn't have bonds, the risk should be automatically 3 out of 10. First of all, take a deep breath. You might need some Ozempic, okay? Take a chill pill. I say from time to time on the channel, I'm not a big fan of bonds. Unless you're 55 or you're saving for a very large purchase or your risk tolerance is lower than mine, like I think my risk tolerance is as conservative as it comes. But if you can't tolerate any risk, then yeah, I guess a 20%, 30%, 40% allocation to bonds makes sense. At 36, for me, I fundamentally disagree. And I'm not trying to step on toes, but I know for a fact that what I just said might have made a bogglehead foam at the mouth. You're already typing up a very racist and angry comment, but keep in mind that Kevin has a guaranteed pension. It doesn't matter if this portfolio goes belly up, he's gonna get a pension from the government, right? The pension acts as his synthetic bond. It's essentially gonna be guaranteed income that covers his essential needs as he hits 60, 62, 64, right? And then at that age bracket, he's also gonna be able to collect his Social Security checks. That's why he's willing to forego bonds and just invest into every NVIDIA, Google, and Microsoft around the world without losing sleep. I say around the world because I think in China it's like Alibaba, Tencent, and in Europe it can be Spotify, and in Canada it can be Shopify. With his portfolio, he's invested into all of it, the good and the bad. And so when we move on to the next metric, the quality of holdings, ranging from a grade letter of an A down to an F, here in the US, a grading system, F means failure. Horrific, atrocious, ugly, racist, short, has a speech impediment, might have small eyes like me, just the lowest of the low. A being awesome for Amos. When it comes to, dude, why I'm so stupid? What am I even saying? When it comes to Kevin's portfolio, I would argue it's an A-. Despite not having a reputation like BlackRock or Vanguard does, I think Avantis, it's a solid fund management, which is what a bulk of his holdings are from. I'm personally not bullish on small caps over the long run like Kevin is. However, I agree with him. I think right now, I do think it's the category that's going to benefit the most from interest rate cuts that should be coming soon. Well, I don't know if it's going to come or not. However, that's what the speculation is, right? Because as the federal interest rates come down, that's going to mean lower financing costs that tend to support the smaller companies who live or die by the loans when they're ramping up. When you're just getting started with your business operation or enterprise, believe it or not, a lot of these entrepreneurs, they're highly leveraged. But given like 3 to 5 years, once you ramp up and you become profitable, and you pay down the loans, then you see success. But if the interest rates are too high, sometimes the loans are just not feasible, or you don't want to take on as much. And so instead of aggressively growing, you're only going to be modestly growing because you don't want to take on too much loans. So the fact that Kevin's going into small caps right now, I see nipple to nipple with him. It's like my right nipple has a piercing and his left nipple has a piercing and we're connecting. I can see we're on the same brain wavelength. And then obviously, as I just alluded to, I'm very bullish on the American markets, but we cannot deny that money has been rotating out of US equities and into overseas stocks. At least it has been for the past 1 year. So what Kevin is prioritizing, I think it makes sense in the short run. Because I think the current party in power, they're still in office until 2028. And as the current administration continues with the tariffs and policy uncertainty across the board, because that's one thing the stock market hates the most, is not knowing what's to come. The unpredictability causes them to be fearful and causes them to act and behave irrationally. Even though the stock market on any given day is irrational, When there's tariffs and we're severing relationships with our partners and our allies, it makes them even more delulu and crazy. So if I were to pause and remove myself from my brain, I can completely see why Kevin's doing what he's doing. So what would I do differently if I had to improve this portfolio? What are the opportunities for improvement, as they say in corporate talk? Drives me up a wall when you think about corporate talk. Instead of just saying constructive criticism or feedback, it's opportunities to improve. Hi, Parker, we've noticed that you've been late. Like, shut up, man. Okay, the traffic has been ridiculous. And then the other day I had to hold in a fudge brownie because I was about to poop my pants. It's not like I'm late every single day. Just give me a break. So, if I had to treat this as an MBA case study and I had to improve it, this is what I would do. But please keep in mind, I'm a broken record at this point. This is not financial advice, and I'm just talking to myself because I'm a lunatic. I wear a tinfoil hat, and I may or may not be wearing pants. Actually, I am. And honestly, when it comes to Kevin's portfolio, I wouldn't make drastic changes. And that's the awkward part. I almost feel embarrassed because usually I see portfolios that need open heart surgery. It's hideous and we need to patch this up and we need to be like, dude, what are you doing with this one? However, in the context of Kevin's portfolio, this one does not. I think it only needs minor adjustments here and there, kind of like fine tuning or topping off on the oil. I think the macro thesis is clear. He's intentionally putting himself into heavier international exposure and prioritizing small caps to benefit from the rate cuts. So if you believe in that thesis to pan out, then his structure and his tactics game plan, it makes all the sense in the world. Now, me personally, instead of going into the international stocks that are soaring to all-time highs, I'm choosing to buy the highest quality US stocks as they continue to get hammered day after day. Because it's not every day that the markets get it wrong and they present you an opportunity to buy into something that you've been eyeballing for the past 5, 6, 10 years. And lo and behold, now's the chance. And now I want to run out of the store? You want to give me 50% off a stock that I wanted to buy for 10 years? No, I don't want nothing to do with it. Dude, that just sounds ridiculous. Even coming out of my butthole, doesn't it? Like, what in the hemoglobin? So me, you give me that chance, I'm literally going to bow down to you, say thank you, and just start dollar cost averaging. Obviously, I could be wrong. Maybe it's a bad decision. I guess we will see, but that's what I plan on doing. But this video is not about me, it's about Kevin, right? So as we jump on over to the next sheet, take a look at my notes. So as we look at the breakdown of his portfolio right now, adding some color and commentary to his positions, he has 64% of his portfolio allocated towards the S-Fund, and essentially a proxy is the Vanguard's VXF. It's everything outside of the S&P 500, small and mid-cap companies. So it's not going to be companies that we all know and love like Microsoft, Amazon, Tesla, Palantir. Instead, it's going to be companies that might have a long history and a track record. It's just their market cap is small because their growth has been negligible, or it's a startup and they're ramping up. So it's kind of all across the board when you talk about the small caps. And then his next biggest holding is in AVIM, which is the emerging markets internationally. This includes China, India, South Korea. Personally, I'm bullish on that as well. I'm not invested into it, but I can see why he has 12% allocated towards it. And then he also has about 2.9% of his net worth invested into AVDE, which is the International Core Equity Stocks, and that's developed markets such as Europe and Japan and etc. But what kind of throws me off is that when you think about the TSP, you don't really have that many options, right? He only has $200 invested into the C-Fund, which is a proxy for VOO or SPY, the S&P 500. And then I decided to add another column with the CAGR, the compound annual growth rate, the performance of the ETF in question, because I'm going to be completely honest with you, prior to researching and making this video, I had never heard of Avantis or even Dimensional, which is the DFIV represented right there. But between you and me, I don't need to know what their Starbucks order is, right? Because the CAGR, that's a common language that we can understand. We might not know anything about each other, but CAGR, you're talking my language, right? Because it's the results of their strategy. And I think across the board, every single ETF is pretty respectable. I think the best performing one is this one by Avantis, the International Small Cap Value, represented by AVDV. And the worst one, not by a significant margin, is the S-Fund, which is the US small and mid caps. Their CAGR is 9.5%. So going back to the potential improvements, so given Kevin's macro outlook, I'm a little surprised that he does not have allocation to gold or silver. Because if you're bearish on the US, historically, the rotation tends to be towards hard assets like gold and silver. So it's not a hard ask. However, I do think it would be interesting to hear why he prefers staying fully in equities. And then number two, speaking of historically, like it's an academic research when realistically, you just read a post off of Facebook that was generated by AI slop and you treat it like it's research. We all know someone like that out there. Nonetheless, historically, small caps have had long stretches of underperformance relative to their cousin from West Virginia, the large caps, the blue chip companies. This C fund, essentially the S&P 500, has been a more consistent compounder over time as represented by their CAGR, 11.4%. So it's a personal thing. However, I think Kevin has way too much exposure into the small caps. Fully understanding the thesis of the next 2.5 years, I think if we were talking like maybe 10-15% exposure to the small caps, wouldn't be a big deal. But when we're talking about just right here in the US exposure alone, over 70% into small caps, and then when you bake in internationally, another 5.8% into the small caps, that's when I get an issue and a dilemma with it. Because when you think about the small caps, as I just alluded to a second ago, there's good stuff and there's kind of ugly stuff as well, right? There's quite a few unprofitable companies that have small market caps. That's where they get categorized. Penny stocks are small cap. Whereas on the other hand, the big names, the blue chips for the most part, they do tend to be profitable and proven operations, and that comes with a big market cap. Now, obviously the upside of a company that has $1 trillion market cap, its growth, like the trajectory might not go as fast as a company that trades with a $100 million market cap. For him to go to $500 million market cap and 5xing, the probability and statistics of that, I can see it if they are truly a hidden gem. However, the data shows us that the small caps underperform the big caps over the long run. So rather than playing into the short-term what ifs going into 2027 and 2028, I'd rather just go with the tried and true. Let's take a look at what I'm talking about. In the timeline, February of 2016 to January of 2026, just comparing the large caps, the S&P 500 represented by VU, and then obviously the small mid caps represented by VXF, proxy for the S-Fund. And we take a look at what has transpired in roughly 10 years. For the S&P 500, their CAGR, which is their performance year over year, is 15.5%. For the S-Fund, the VXF, it's 12.3%. Now, obviously, I certainly do think in 2026, the VXF, I do think they're going to outperform the S&P 500, but who is to say that's going to happen again in 2027 and in 2028? And if we take a look at their performance year over year, I think that's what seals the deal for me. Represented by blue is the S&P 500, and teal is represented by the S-Fund VXF. When the times are bad, just look at how much more it drops. Right? In 2018, the S&P 500 was 4.5% into the red. For the S-Fund, it was essentially negative 9.3%. And again, in 2022, the S&P 500 was negative 18%. The S-Fund was negative 26.5%. Then what makes it a toss-up is when the times are good, they take turns outperforming. For instance, in 2016, the S-Fund was 27% into the green. The S&P 500 was 18%. However, if you take a look at 2021, the S&P 500 2x that of the small caps, right? And they take turns outperforming one another, but I think what's more important is the volatility to the downside. And for me, the small caps, as you can see, when the times are bad, dude, they get their knees bashed in by a Balkan neighborhood bully with a baseball bat. He will just smash your knees, even when you're begging him to stop. However, if we are going to be scientific about this, when you blend it out over the long run, I think there's a clear winner. The CAGR of the S&P 500, which is the C fund, is 15.5%. For the S fund, 12.3%. And even on their own website, you can clearly see the performance of the C fund to that of the S fund. And since the inception, for the S fund, their CAGR has been at 9.5%. They were conceived and born into the world in 2001, whereas for the C fund, that was in 1988. So a lot more data in history to work with, a lot more bull and bear markets, 11.3%. So even the data over the really long run shows us that the C fund, the S&P 500, outperforms the small caps. However, a caveat is in 2026, Kevin's right. So even though over the long run, the small caps, they do have stretches of underperformance, I think right now, it just so happens to be the perfect storm for them to thrive. So maybe small caps is the right move. So okay, Kevin, I hear you. And then if we try this again with the S&P 500 against the international stocks, including all of the market caps, big or small, fat or ugly, using the exact same timeline of February 2016 to January of 2026, well, I think the data is a lot more interesting. For the S&P 500, commonly referred to as the market, the CAGR is 15.5% once again. However, for the international stocks, 9.7%. It's a very interesting dynamic. I would argue up until 2024, the S&P 500 was better, except for 2017, and I guess 2022. In 2025, that's a huge difference. The S&P 500 was 17.8% to the green, international stocks 32.3%, and that's also when the tariff debacle was at full throttle. And in 2026, I think the difference is also pretty drastic. So once again, historically, even though international stocks and equities have lagged behind the US, I think the valuation gap is absolutely massive right now. I see the opportunity and I can see the thought process. And I'm not trying to be a gypsy that's going to pretend like I can see the future. However, I do think the international stocks are going to see superior alpha over the next 3 years, as the money from hedge funds, amateur investors, retail traders, as it rotates overseas. Unless, of course, stability and predictability returns to the American geopolitical landscape, which, between you and me, I'm not trying to be a negative Nancy here, I don't see that happening. I do think volatility and uncertainty and keeping everyone on their toes, I do think that's the name of the game. So if this is Burger King and I gotta have it my way, what you see on your screen right now, this is exactly how I would adjust or modify this setup. I deleted the two Avantis funds, the large and the small cap, because why bother with both? Why not just go into the S&P 500? That's neither here or there. So instead, I put it into SPMO, which is also actively managed, and they invest into high momentum US equities. So if we take a look at their top 10 holdings, actually we can do that right now. Year to date, they're pretty much flat. If we go back 12 months, 21% into the green, take a look at their top holdings. NVIDIA, Broadcom, Meta, JP Morgan Chase, the top 10, all of them have a lot of hype and attention except for Visa. I think they're pretty much flat for the past 1 year. Sorry about that, negative 10%. Visa, I did look into, I think last weekend. My conclusion, I don't think they're undervalued. Crazy as it might sound, given their trajectory and their future and their numbers, they're fairly valued. But they are on my radar, just I wouldn't buy into them at $300+ a share. And the thought process behind that is instead of being content with a 12.8% CAGR or 11% CAGR from the Avantis funds, with SPMO, since its lifetime, the CAGR is 17.6%. Now, obviously, if you're not a fan of SPMO, the other ones that I really weighed heavily, like should I have put it in here or not, it also includes VUG and SCHG. not the dividend one, the growth-oriented one. So that's one small adjustment I would make on the US Buy America side. But in the other Buy America side internationally, I also deleted all of the various ETFs from Avantis and Dimensional, and instead I put it all into IMTM, which is the international flavor and variety of SPMO. It actively invests into high momentum international stocks, and their CAGR is a very respectable 11.9%. And so when you put the two international ETFs up against one another, their CAGR, the difference is negligible. I think they're both around 12%. And I could absolutely be wrong, but I think this would produce better fruit, especially if you're bullish on the international markets. I did look into VXUS, which is the Vanguard's international it's VTI for the international stocks, but it underperformed IMTM. And then I went back and forth on whether or not I wanted to add SCHD. Do I have to resist the urge to put my propaganda in here saying SCHD deserves at least a 1, 2, 3% allocation, but Kevin does not care about dividends right now, so it wouldn't make sense to just forcefully put SCHD, right? So as it stands, this portfolio, believe it or not, what do you think is going to happen over the next 10 to 20 years? Well, let's take a look at it hypothetically, right, in a perfect world. But before we go ahead and do that, remember the portfolio's valuation, $169,250. So under the parameters and conditions of what's to unfold for the next 20, 23 years, we're insinuating that the share price appreciation, the portfolio is going to grow by 10% year over year. Even though the data says 11.9%, 17%, we're just going to play it very conservative. And then for the dividend growth rate, it doesn't really matter because the yield is only 1.3%, but we're going to go ahead and say that dividend growth rate is 7%, even though realistically it's around 9%. So after 23 years, I think the results not half bad, because as of right now, Kevin's 36, he's going to be 59 years old, and his portfolio will be $3 million as long as he continues to invest about $1,000 every month. So annually, that shakes out to about 12 grand. And some of you might say that's unrealistic, but remember, he has very low overhead costs. And I think what's crazy is even though it's not a dividend income focused portfolio, he would still generate $20,600 in dividends per year 23 years from now. The monthly dividend payout would be $1,700. And if you bake in the pension plus the Social Security checks, and assuming that the mortgage is paid off in about 23 years, I think this is not bad at all. So what's doing most of the heavy lifting? Obviously, it's going to be the 10% share price appreciation from the various ETFs, SPMO plus IMTM, and then 5.6% from the initial investment. If you want to take a look at the total portfolio valuation throughout the years, I think it's kind of a cool thing to see. In roughly 10 years from now, the portfolio is going to be just shy of $700,000, and in 15 years, it should be $1.2 million, and in 20 years, $2.1 million. And then the span of 3 years, it grows to $3 million. So that's the cool thing about investing and compounding, right? Once it gets up to a certain valuation, it snowballs faster and faster. Like if you only have a portfolio that's worth 10 grand, like getting it up to 20 grand might seem like climbing Mount Everest without an oxygen tank, when you and I both know the Sherpas are carrying everything on their backs while you're just waltzing your way to the top. But I digress. Once the valuation of your portfolio gets bigger and bigger from discipline of dollar cost averaging, and it gets up in valuation, it just gets bigger faster. Does that make sense? Like in 20 years, 2.1 million. In 23 years, just adding 3 more years, it gets to another million, $3 million. Case in point, to 2x from its current starting point of about 169, it would take roughly 4 years. In 4 years, it'll be $317,000, and then to 2x from there would take roughly 9 years, and then to 2x from there to turn into $1 million from year 9, it would happen in year 15. So besides the 2 adjustments that I have made, I would also reallocate and prioritize additional contributions from the S-Fund into the C-Fund, and that's why I have it highlighted as yellow. So what do you guys think of Kevin's portfolio? Do you love it? Do you hate it? Do you agree with him that the small caps and the international equities will outperform over the long run, over the short term? Let him know, because I'm certain he's going to be in the comments section, and I'm sure he would appreciate any feedback, unless you start talking about how handsome he is in his profile picture, and you make advances towards him because of his pension check. I'll have you know up front, he's not interested. He's happy as he is. And before I sign off, I wanted to leave you with something that's bigger than money. Please hear me out. You know how as men we can find ourselves in a bad mood for no reason at all? Like we can wake up one day and just be pissed off, irritable, just in a mood to complain. Literally nothing could have happened and you could be a grouchy Gary all day long. If that's true, then the opposite is also true. If you can be in a bad mood for no reason, you can choose to be in a good mood for no reason as well. Not because your life is perfect, not because everything is going your way, not because you're 6'3" and you're handsome and you have a fairy tale life, but because you've decided that you're not going to let every minor inconvenience knock you off center and to ruin your day and poop in your shoes. I honestly think one of the greatest skills a man can develop is the ability to stay in a good mood, even when there isn't anything obvious to celebrate. That kind of emotional control is true strength. Anybody can be a dick. Anybody can be a douche. Anybody can raise their voice or be angry. That's not what makes a true man. A true man is able to control his urges and temper and be calm in a situation where other people would be irrational. And I'm not just saying for one moment. I'm advocating and I'm suggesting choose to be in a good mood for the whole day. From the moment that you wake up to the moment that you floss your stinky little teeth and when you decide to go to bed. It's a choice you got to keep making throughout the day. It's knowing when to pause before you respond. It's knowing when to breathe instead of reacting. It's knowing how to soften your tone instead of cussing like an idiot. Knowing when to let something go instead of letting it live in your head rent-free. Because you and I both know when you do that, your whole day just gets worse. Because if you don't do what I'm talking about, you know this is true. It spills over. It affects your conversations. It affects how you treat the people that are closest to you. It follows you to work, your home, your decisions, and you can't even sleep at night because you're all worked up, right? Your mood shapes everything. It influences how you interpret situations, how you talk to yourself, how patient you are, even how your body feels physically. If you're in a piss-poor mindset and mentality and you're stressed out, you best believe your receding hairline is going to get worse. And think about it like this. If you're constantly in a bad state and you're always leaving hater comments on the internet and you're just a negative person, that becomes your default setting. And here's something that most people don't realize. If you are miserable to be around, I hate to say it, but you're probably miserable to yourself as well. When you make a mistake, you don't correct it calmly. You start attacking yourself, you start cussing yourself out, you start punching and breaking things. When you lose money, you don't learn from it. Instead, you spiral. You start gravitating towards a bottle or other stuff. And when something goes wrong, your temper doesn't just hit others, it hits you as well and hard. Psychologically, you know how to hurt yourself more than anyone else knows, right? We know our deepest pain, scars, and our buttons, and we push it. So once you realize how much your mood shapes your entire life, your entire outlook, dude, you're gonna stop handing your peace over to situations that do not deserve it. And honestly, this might be more important than dividend investing itself. Yes, coming from a guy whose channel is Dividend Compounders with Cheese, this might be more important than returns, CAGR, international versus US equities, more important than any portfolio roast. Because what's the point of building wealth if you're unbearable while doing it, if you're miserable and you're angry and you're irritable? So I'll leave you with this. Choose your mood and protect your peace, because that's a different kind of wealth.